Hello, this is Eric Parnell, Chief Market Strategist from Great Valley Advisor Group. Over the last 2 years, you've joined me for Market Insights, talking about the economy and financial markets all around the world. Well, today we enter a new chapter, and it's my pleasure to introduce to you Evan Coffey, a person who's part of my team here at GVA and helps collaborate on the things that we do behind the scenes. So with that, I'd like to introduce Evan Coffey. You'd like to share a little bit about yourself.
Thank you, Eric, for the generous introduction, and thank you to GVA for giving me the opportunity to join Eric on these Market Insights videos. My role at GVA is largely analysis and research focused. So whether it be individual securities or the broader macroeconomic landscape, I think that I can really add subject and context to these discussions. So I'm looking forward to working with you.
No, I'm looking forward to it as well. And one of the things that you'll see in the conversation that we have today and going forward, it's an opportunity for you to see some of the conversations that we're having behind the scenes and some of the things that we're exploring and debating as we go through the asset allocation and investment research process. So we're really excited about it. And I know you also do a good job of keeping me in check as you do behind the scenes as well. So with that, so what are some of the things that you think we need to talk about today?
Yeah, so first and foremost, these Market Insights videos will have a little bit of a different structure than they previously have. We're going to focus on three main key themes each video, and basically what we want to do with that is create a format that is digestible and structured for our audience, so that at the end of the video they can take away those three major topics and take them, whether it be to their end clients or just out into the world to have more financial literacy. So with that, we can start with the first main theme of this video, which is markets love certainty. Getting into this, really since April 9th, equity markets have trended higher. I think that this is largely in part to the pause in potential tariff rates that President Trump set to July 9th, and this was from the April 2nd Liberation Day. And I think that once investors realized that there was some certainty in the markets around when they might see these potential tariff rates, or better put, a pause in the uncertainty around tariff rates, they dove into risk assets. And so, a prime example of this was this past weekend. We saw President Trump on Friday threaten to impose a 50% tariff on the EU as soon as June 1st. And equity markets didn't like this. They had a rough week last week. They ended on a sour note with major indices down big on Friday. But then over the weekend, we got some news that President Trump met with the EU Commission President, Ursula von der Leyen, and they ultimately sorted out whatever that they needed to sort out on the tariff front, and we've paused those tariffs or potential tariffs to July 9th as well. So my question to you, Eric, is what's the biggest uncertainty for markets moving forward? Is it geopolitical risk? We just saw a major attack on Kiev over the weekend. Is it something more domestic, like the federal deficit, the growing national debt, or is it what I was just talking about and the tariff situation?
Mm-hmm. No, it's a great question. Markets don't go up in a straight line. Sometimes they can go down in a straight line depending on the magnitude of uncertainty, but markets don't go up in a straight line. You hear about the wall of worry. There is always something for the market to worry about. And that's why, you'll see a market move 3 steps forward, 1 step back. What we saw here more recently with the latest tariff announcement against the EU, it was that 1 step back. We thought we were putting the tariff uncertainty behind us, but then there's a new round of tariffs that the market has to grapple with. But the reality of it is, tariffs are an uncertainty, but they've reached a juncture where they're no longer necessarily an uncertainty that's going to pull the markets to a downside in any meaningful way. We had that stretch of time from February 19th to April 9th, where the stock market fell by over 21%. And the reason is that, the market knew tariffs were coming in February and March. We hit April 2nd, we get the announcement of Liberation Day, and the 10 to 15% tariffs that investors thought were going to be applied to countries all across the world, it turned out to be 20%, 30%, 40%, these unexpectedly high tariffs.
Yeah.
And so investors are like, whoa, wait a second. And all of a sudden, everybody stepped back and the markets were left going to the downside. Another risk that people have concerns about is, like you mentioned, geopolitical risks, situation in Ukraine, the threat of geopolitical conflict breaking out in other parts of the world. That has always existed. And what we have seen going all the way back through time is that you have these events take place. The markets might pull back for a day or two, but after that initial shock of the headline of some sort of geopolitical event taking place, markets almost always invariably bounce to the upside. And the most classic and arguably best example of this would be during 9/11. Tariffs aren't an uncertainty that should adversely affect the markets at this point. Geopolitical risk is not an uncertainty that should affect the markets at this point.
So, with that being said, we're at 59.05 as of noon yesterday on the S&P. What would shake markets over the next month?
No, it's a great question, because one of the things that we have seen going back to the market lows on April 7th, where we traded below 48.35 on the S&P 500, it's been a tremendous bounce back. 2 days after that low, we got the 90-day pause, and the markets had a very strong move to the upside. And in the process, made a lot of progress in making back the losses. We're above Liberation Day highs, and we're making our way back to those February 19th all-time highs. The biggest downside risk confronting the markets to this point was the same catalyst that caused the 90-day pause in the tariffs to begin with, and that's what we see in the bond market. We have seen a fairly sharp rise in Treasury yields, hitting a low of 3.86% on April 7th, the morning of April 7th, going all the way up to 4.6% here in the days and weeks since. On the 30-year Treasury yield, it's punched above 5% recently, the highest levels we've seen on the 30-year Treasury yield, going all the way back to before the financial crisis. The fact that investors are requiring a higher interest rate to lend money to the U.S. government suggests, not only a pressure on the financial system, but it also creates an environment where investors have a greater alternative. But it also raises the question of what's pushing those interest rates high. Why do we have a 30-year Treasury yield that is its highest level in over 20 years as we sit here today?
And with that kind of brings us to the second major theme of, is there a buying opportunity in the long bond? You mentioned where we're at. We're knocking on the door of 5% on the 30-year Treasury. These are numbers, to your point, that we haven't seen since, besides briefly in 2023, we haven't seen since before the great financial crisis. Is this deficit driven and this new tax and spending bill that's made its way to the Senate, or is a broader sign for markets that we're not in the place that we think we are? People typically reference the long end of the Treasury curve as the bellwether for the broader market. So do you see there being a ceiling on the 30-year yield? Or, to my point, is there a buying opportunity in the long bond?
Mm-hmm. Now, one of the things I always enjoy about our conversations, always good questions, always good topics.
I appreciate that.
And it comes back to a point that we've talked about in Market Insights going back over the last 2 years. The primary downside risk to financial markets, whether it's the bond market or the stock market, is the threat of inflation and the threat of a renewed rise in inflation. We go back to 2022. What caused the bear market in 2022? We had the onset of COVID in 2020 and a massive injection of stimulus, both fiscal policy, which is the government in Washington, as well as monetary policy, which is the Federal Reserve. A massive injection of stimulus in order to get the economy sustain itself in the midst of a period where everything was shutting down. But then the economy reopened, and all that stimulus was still out there.
Yeah.
In fact, there was more stimulus that was continuing to come, even though the economy had moved past COVID. And what that resulted in was in the first major outbreak of inflation in this country, going all the way back to the 1970s and the early 1980s. And that caused that bear market in 2022. What is the primary determinant of bond market returns, which then feeds through to stock market returns, is inflation. If you get an outbreak of inflation, It will cause Treasury yields to rise, which will cause corporate bond yields to rise, which will cause the cost to get a mortgage, which you see in mortgage-backed securities, it will cause those to rise. The higher those yields go, the more it puts pressure on the stock market, because how do stock valuations get set? They get set, the basis of what sets stocks valuations is what yields are in the bond market. So if you get that inflation, it just feeds its way all the way through.
Yeah. Well, I think you make a great point. First on the federal deficit. Later this week, my latest article will be covering the federal deficit and the market implications around it. So I'm with you in that this isn't a new phenomenon. We've run a deficit, and the last time we ran a surplus was 2001. So it's not a new phenomenon, and thus markets have buzzed right over it. So I think that you bring up a great point there, and then you also bring up a great point that inflation likely is this leading determinant in broader financial markets. So with that, you've done a great job segueing me.
Thank you, appreciate it.
To each point. Our third theme is the dichotomy between hard and soft data. So with that, there continues to be this gap between how the American consumer feels and how the economy is functioning. We see up until yesterday, we got a great consumer confidence number yesterday, but prior to that, we saw consumer confidence and consumer sentiment numbers at decade lows, or really, we saw brief blips during the COVID crisis, but prior to that, numbers that we really hadn't seen since the GFC. But GDP, break-even inflation, unemployment, they all remained rock solid. So walk me through this dichotomy, this bifurcation between how the consumer feels and the economy, and what you see going forward between this relationship.
Yeah, and it's, you mentioned your Markets in Depth article. It's one of the things that I enjoy about reading those articles is because, the writing that I do tends to be, more thematic at a higher level. The analysis that you provide, and I suspect that you're probably going to touch on a lot of the things that I'm about to enter into now, gets into those details in terms of what's affecting the economy and affecting the market. And I think you hit on a key point. You're hitting on a key point, that dichotomy between soft data and hard data. And it's one of the things that really rang true during that entire period when the S&P 500 was falling by 22% from February 19th to April 7th. There was so much focus on the qualitative, the soft data, consumer sentiment, consumer surveys. How do you feel about what's going on right now? There was a lot to worry about, and you were seeing the markets fall day after day. And you heard from institutional investors that were talking about the fact that, there's uncertainty in terms of what's happening right now. We don't know how this is going to play out. This was so unexpected. It is completely understandable for people who are hearing this. They're hearing this news and they're saying, this is going to be bad. Soft data is sentiment. What are people feeling? But the hard data tells us, what are people actually doing? What's actually happening? One of the things that we saw throughout this entire episode when the market pulled back 22%, the hard data continued to look very strong. And one of the things that we've seen since April 7th when the market's bottomed, the hard data continues to be strong.
Yeah.
Economic growth in the United States still projected to be 2% plus through the remainder of 2025. Corporate earnings growth, which is the primary driver of stock returns, is projected to grow at a double-digit rate through the remainder of 2025. Let me put this into context. In 2024, we saw the stock market go up 25%. And corporate earnings only grew at a high single-digit rate.
Yeah.
And we're talking about double-digit earnings growth for 2025. And the other key here, because I talked about it as a primary downside risk, this threat of inflation, yes, we have these tariffs that are being imposed. And yes, we're seeing those price increases kind of filter through to some of the things we're buying on a day-to-day basis. But the fact of the matter is that when you take a look at the markets from a broader inflation expectations perspective, it's expecting less inflation now than it was before the tariffs were announced 2 months ago. Strong economic growth, strong corporate earnings growth, low inflation expectations. That's a nice combination for markets through the remainder of the year.
Overall, from your dialogue, it sounds like the hard data is signaling that we're in a much better situation than the consumer might feel right now.
Absolutely. We see a lot of uncertainty, and uncertainty is going to continue to happen going forward. We're going to have volatility. That's the nature of markets, and that's always been the way that it's been. But there's a lot of reasons to be constructive in the economy and the markets that we're operating in right now. We've seen a huge recovery since the early April after the 90-day pause was announced. And it's really very reasonable to expect that we could see the S&P 500 and the U.S. stock market trading at new all-time highs by the middle of June. So volatility continuing, absolutely, but there's good reasons to be constructive as we go through the remainder of the year. Thank you for joining us for this latest Market Insight, and we look forward to seeing you again soon.